I want you to picture someone who did everything right. They bought Bitcoin in 2020 when most people were still laughing at it. They held through the crash. They watched their $15,000 turn into $180,000 at the peak of the cycle. They had friends asking them for advice. They had a portfolio screenshot they were proud of. On paper, they had made it. Today, 3 years later, they are broke. Not broke in the way people exaggerate when they overspend on a vacation. Actually broke. Behind on rent, credit card debt accumulating, no emergency fund, stress that wakes them up at 3 a.m. The $180,000 is gone, not because Bitcoin collapsed, though it did correct. It's gone because of a series of decisions that felt completely rational at the time and only look catastrophic in hindsight. This is the crypto millionaire poverty trap, and it is far more common than anyone in the crypto space wants to admit. The trap doesn't catch people who lose money in crypto. It catches people who make money in crypto and then lose everything anyway. It catches people at the exact moment they should be building generational wealth. It catches them precisely because success in crypto creates a specific set of psychological conditions that almost guarantee financial destruction if you don't understand what's happening to you. Today, I'm going to walk you through exactly how the trap works, who it catches, why even intelligent and financially aware people fall into it, and the specific rules that separate the people who convert crypto wealth into lasting financial stability from the people who cycle through fortune and poverty over and over again, never understanding why the money keeps disappearing. Let's start with what the trap actually is, because most people misidentify it. The crypto millionaire poverty trap is not about losing money in a bear market. Everyone loses money in a bear market. The trap is about the lifestyle, the identity, and the financial structure that people build around paper wealth, wealth that exists on a screen but has never been converted into anything real. Here's how it begins. Someone makes a significant gain in crypto. Not necessarily $180,000, could be $40,000, could be $800,000. The number doesn't matter as much as the psychological shift that happens the moment they see it. Something changes in how they think about themselves. They start to see themselves as someone who has money, and people who have money live differently than people who don't. The spending starts subtly. A nicer apartment because they can afford it now. A better car because they've earned it. Dinners at restaurants they used to walk past, clothes that reflect the version of themselves they've become. None of these decisions feel reckless in the moment. They feel like the natural expression of success. They feel deserved. What they don't feel like, and this is the critical part, is permanent debt against an unrealized asset. Because that's what they actually are. Every lifestyle upgrade funded by crypto wealth that hasn't been sold is a bet that the price will stay high long enough for the lifestyle to become sustainable, a bet that the number on the screen will remain real long enough to become real in your actual life. Most of the time, that bet loses. The first mechanism of the trap is what I call the paper wealth illusion. Human beings are genuinely bad at distinguishing between money they have and money they can see. When your portfolio says $180,000, your brain processes that as having $180,000, even though you haven't sold a single coin, even though that number could be $90,000 by Thursday, even though the tax bill alone on a full liquidation would take $40,000 of it away. The paper wealth illusion is why people make spending decisions based on portfolio highs they will never actually realize. They see the peak and anchor to it. When the price drops 30%, they don't feel 30% poorer because they never felt like they had the peak amount in any real sense. They just feel like they're temporarily down and that the number will come back. So the lifestyle continues, the spending continues, the identity of being someone with money continues, even as the actual money evaporates. The psychological research on this is consistent and sobering. People dramatically overestimate their willingness to sell at a target price and dramatically underestimate their tendency to hold through losses. The same person who tells you they'll sell at $80,000 will, when Bitcoin hits $80,000, tell you it's going to $150,000. The target moves. It always moves, because selling feels like losing, even when selling is winning. The crypto millionaire poverty trap is built on this foundation. Unrealized gains create a false sense of wealth. False wealth drives real spending. Real spending creates real liabilities, and then the correction comes. The second mechanism is lifestyle inflation with no corresponding income increase. This is where the trap becomes structural rather than just psychological. When someone earns a $40,000 raise at their job, their lifestyle can reasonably expand. The income is recurring. It will be there next month and the month after. Building a lifestyle around it is rational because the foundation is stable. When someone's crypto portfolio gains $40,000 in value, nothing has changed about their income. Their salary is identical. Their recurring financial capacity is unchanged, but their lifestyle expands anyway, as if the gain were a raise, as if the money were permanent, recurring, and guaranteed. It never is. The most dangerous version of this pattern involves people who quit their jobs because of crypto gains. I have seen this repeatedly. Someone has a portfolio worth, say, $300,000 at the peak of a cycle. They calculate that if they can earn even a modest 5% on that, they can replace their salary. They feel financially free. They quit. They start spending from the portfolio because that's what financially free people do. Then the bear market arrives. The $300,000 becomes $90,000. The income they gave up is gone. The lifestyle they built around financial freedom doesn't scale down easily because lifestyles never scale down easily. Fixed costs have been added: the nicer apartment, the car payment, the subscriptions, the habits. And now they're drawing down a depleted portfolio to fund a lifestyle that was always built on sand. The job they quit has been filled. The career momentum they had is interrupted. The colleagues who vouched for them have moved on. Getting back to where they were professionally takes years. Meanwhile, the portfolio continues to deplete. This is not a rare story. This is a pattern that repeats every single crypto cycle, with new participants who have never seen it before and therefore have no reason to expect it. The third mechanism is the investment cascade. Crypto success doesn't just change how people spend, it changes how they invest, and this is where wealth that survived the initial spending is systematically destroyed. Someone who made money in Bitcoin almost always believes, consciously or not, that their success was a product of their judgment. They saw what others missed. They were early when others were late. They were right when others were wrong. This belief, even if it's partially true, creates dangerous overconfidence in the next decision. So they take the profits from Bitcoin and put them into the next opportunity. Sometimes it's an altcoin that promises even greater returns. Sometimes it's a DeFi protocol with extraordinary yield. Sometimes it's a friend's startup, a real estate deal that requires leverage, an option strategy they watch someone explain online. The common thread is that the decision is driven by the psychology of someone who believes they have the ability to identify extraordinary opportunities because they did it once. What they don't account for is that Bitcoin in 2020 was a specific opportunity at a specific moment with specific conditions that aren't automatically replicable. Being early to Bitcoin didn't make them a great investor. They were early to Bitcoin. Those are different things. The investment cascade turns one good decision into a series of increasingly poor decisions, each one funded by the proceeds of the last. By the time it's over, the original gain has been cycled through multiple failed bets, each one rationalized at the time as the obvious next move. The fourth mechanism is the tax catastrophe. This one is practical rather than psychological, but it destroys more crypto wealth than almost any other factor, and it does so in a way that people don't see coming until it's too late to do anything about it. Here's how it unfolds. Someone buys Bitcoin. Bitcoin goes up. They sell Bitcoin to buy an altcoin that they believe will go up faster. The altcoin goes up. They sell it to buy another position. They make several more trades, each one seemingly profitable in crypto terms. Then the bear market hits. The final position they're holding crashes 80%. They've lost most of what they had. What they don't realize until they sit down with a tax professional or receive a notice from their tax authority is that each of those profitable trades was a taxable event. The gains they reinvested immediately without ever touching the money still generated a tax liability at the moment of each sale. And now they owe that liability on gains that no longer exist. This is not a hypothetical. This is one of the most commonly reported financial catastrophes among crypto investors. People who thought they were cycling gains into larger positions discover that they owe $40,000, $80,000, $200,000 in taxes on gains they no longer have because they were sitting in a crashing position when the bear market arrived. The money to pay that tax bill has to come from somewhere. And if the portfolio is now worth less than the tax bill, it has to come from savings, from selling other assets, from borrowing, or from payment plans with tax authorities. People who were worth $500,000 on paper find themselves not just broke, but in debt to governments, with damaged credit, liquidated other assets, and financial lives that take years to repair. The fifth mechanism is identity capture. This is the most subtle of the mechanisms and in some ways the most powerful because it operates at a level that most people never consciously examine. When someone makes significant money in crypto, their identity often shifts to incorporate that success. They become the person who knows about crypto. They become the person in their social circle who has made smart financial moves. They have opinions that get listened to. They have an image to maintain. This identity capture creates a set of behaviors that are financially irrational but psychologically necessary. They can't sell at the right time because selling feels like abandoning the thing that makes them who they are. They can't admit losses publicly because losses contradict the identity of someone who is good at this. They keep investing in crypto specifically rather than diversifying because diversifying away from crypto feels like a betrayal of the thing that made them successful. They also tend to surround themselves with people who reinforce the identity. Communities where everyone is long on crypto, where bearishness is treated as weakness or ignorance, where the narrative of inevitable success is constantly reinforced by everyone around them. These communities are not neutral information environments. They are identity reinforcement machines, and they are extraordinarily effective at keeping people in positions long past the point where any objective analysis would suggest exiting. The identity-captured investor holds through losses that a rational observer would exit in days. They average down on positions that are failing because not doing so would mean admitting the identity was wrong. They have conversations with family members who express concern and dismiss those concerns entirely because the family member doesn't understand what they understand, or so they believe. So what does the other side look like? What does the person who actually converts crypto wealth into lasting financial stability do differently? The answer isn't complicated, but it requires a willingness to think about crypto not as an identity or a lifestyle or a signal of intelligence, but as a tool for building financial margin that makes everything else in your life more possible. The people who escape the trap do 5 things consistently. They sell in tranches, not all at once and not never. They establish price targets before the bull market starts, and they actually execute at those targets, even when everything in the environment is screaming that the price is going higher. They treat a 2x, a 3x, a 5x as a genuine financial win worth capturing, not as a waypoint on the way to something more impressive. They separate crypto gains from lifestyle immediately upon realization. The money from a sale goes into a separate account with a specific purpose: a house deposit, a business investment, an emergency fund, an index fund. It does not go into a checking account from which lifestyle decisions are made. The physical separation creates psychological separation. The gain becomes real money with a real purpose, not abstract wealth that can be spent abstractly. They get professional tax advice before they trade, not after. They understand their liability before they create it. They set aside the tax portion of every realized gain in a separate account immediately, so that the tax bill, when it arrives, is already funded. They maintain income. They don't quit jobs based on portfolio peaks. They treat crypto gains as a supplement to a financial life, not a replacement for one. The income provides stability. The crypto provides optionality. This order matters enormously. When the bear market comes, and it always comes, the person with income survives. The person whose only income was the portfolio is in genuine danger. And they define what the crypto is for before they make significant gains. What is the actual goal? A house, financial independence at a specific age, a business, a safety net of a specific size. The goal exists on paper before the bull market begins, so that when the gains arrive, the decision about what to do with them is already made. There's no deliberating in a moment of peak excitement and peak temptation. There's only executing a plan that was made with a clear head. Here's the truth about the crypto millionaire poverty trap that the crypto community has a powerful incentive to never say out loud. Most people who make significant money in crypto do not keep it. Not because crypto is a scam, not because the asset is worthless, but because the psychological and structural conditions created by crypto wealth are almost perfectly designed to ensure that wealth gets recycled back out of the hands of the people who created it. The volatility that creates the gains creates the losses. The culture that celebrates the wins buries the losses in silence. The identity that forms around success makes rational exit almost psychologically impossible. The people who keep the money are not the best crypto analysts. They are not the people with the best information or the most sophisticated strategies. They are the people who understood at a fundamental level that the point of making money is not to have a portfolio that goes up. The point is to change your actual life, permanently, measurably, irreversibly. Permanent change requires conversion. It requires taking the number on the screen and turning it into something real, something that exists independent of the next price movement. A paid-off debt, a down payment made, an investment in something with different risk characteristics, a savings account that makes your next decision from a position of security rather than desperation. The crypto millionaire poverty trap catches people who never make that conversion, who always believe the number will be bigger tomorrow, so there's no urgency to act today, who build their sense of financial security on a price that moves 10% in a single afternoon, who mistake the feeling of wealth for the reality of it. The exit from the trap is not a sophisticated financial strategy. It is an honest conversation with yourself about the difference between what your portfolio says and what your actual life is. It is the willingness to take a real win, even when an imaginary larger win is still possible. It is the discipline to build financial stability that doesn't require you to check a price chart to know whether you're okay. Because the people who always have to check, who are always waiting for one more run, one more cycle, one more target before they actually secure the life they're working toward, they are not wealthy. They are hostages. Hostages to a number that will go up and down and up and down until one day it goes down at exactly the wrong moment, when the lifestyle is too extended and the income is too thin and the tax bill is already due. That day comes for most of them. It doesn't have to come for you. If this video describes someone you know or someone you've been, share it with them. Most people in the crypto space will never hear this perspective from the communities they're in, because those communities have every incentive to keep them excited, keep them active, and keep them invested. The people who need this most are exactly the people least likely to find it on their own. And if you want to go further, if you want to understand not just the trap, but the specific framework for building real lasting financial stability around a crypto position, subscribe and watch the next video, because the strategy for escaping the trap is simpler than you think. But it only works if you understand why the trap exists in the first place. Now you do.